The Denison Mines Corp. DNN stock price today sits at $3.22, reflecting a closing price from the last trading day, October 30th, 2025, with an after-hours bump of plus 0.020 cents or 0.62% as the market is now closed. The critical insight here, the one that should immediately grab your attention, isn't the modest after-hours movement itself, but rather the underlying factor that keeps pushing this stock's 52-week range towards its recent high of $3.42. It's not simply the overall uranium sector boom, which is a known expectation, but the market's quiet yet persistent re-rating of the Phoenix Project's execution risk. Investors have long believed in the sheer scale and grade of Denison's Athabasca Basin assets, but the real surprise, the reality that's been consistently exceeding expectations, is the company's continuous de-risking of its flagship Wheeler River Project, particularly the use of In-Situ Recovery ISR mining at Phoenix. This isn't just about having uranium in the ground, it's about pioneering the lowest cost, most environmentally sound way to get it out in a highly specialized, challenging geological area. And the market is finally giving full credit to the technical team's progress. Beyond the simple uranium thesis, the common understanding among individual brokerage and institutional fidelity investors is that Denison is a fantastic proxy for the bull case on uranium, a pure-play resource developer whose value is wholly tied to the long-term structural supply deficit and the global need for carbon-free baseload power. That expectation is absolutely correct, but it's too broad, too simple. The deeper reality is that while the rising uranium spot price certainly provides the strong tailwind, the real value creation for Denison is a function of specific milestones that translate theoretical resource into concrete, bankable production capacity. When you look at the recent price action, particularly the high trading volume days that correspond with the August 2025 news of the provincial environmental assessment approval for the Wheeler River Project and the closing of that massive USD 345 million convertible senior notes offering, you see institutional conviction. This isn't retail momentum being chased on a Robinhood app. This is serious institutional financing de-risking the entire construction phase. The convertible note offering, which was upsized from an initial $250 million, shows that the company's ability to secure significant, non-dilutive, and high-quality financing is exceeding market expectations for a pre-production uranium developer. This is a subtle but potent sign of institutional belief in their timeline and execution plan for a 2028 production start. Looking at the recent daily swings, the stock has shown impressive resilience. It saw a healthy pop leading up to the end of October, consolidating around the $3.20 mark. Uranium stocks in general have been volatile, prone to dips on geopolitical news or minor cuts in production forecasts from major players like Kazatomprom, but Denison's quick recovery from these sector-wide dips suggests a dedicated shareholder base who are focused less on near-term trading noise and more on the long-term supply-demand story. The daily volume, which has been robust, often exceeding 70 million shares, indicates strong liquidity and persistent interest, a key factor for any stock in a highly cyclical sector like basic materials. For an online investment or self-investing account, volatility is expected, but the sustained high volume suggests that when shares are sold off, they are immediately being bought back up by investors who see the dip as a temporary opportunity, betting on the long-term energy transition narrative and Denison's production certainty. This level of sustained institutional activity distinguishes DNN from its smaller peers. Institutional conviction and project certainty. The institutional activity is the next critical layer of this analysis. major funds, and large pools of intelligent portfolio capital are placing meaningful bets on this company. The sheer size of the convertible note offering tells us that sophisticated players are willing to provide hundreds of millions of dollars to bridge the company to production. This essentially puts a stamp of approval on the Wheeler River feasibility study. They believe the adjusted base case after-tax net present value of $1.48 billion, which is Denison's effective 95% interest, is achievable because they trust the In-Situ Recovery method's technical viability and the cost estimates of under $420 million in pre-production capital. This shift from exploration speculation to pre-production execution is a major inflection point. Most uranium stocks trade on the hope of a project coming online. Denison is trading on the solid financing and environmental clearance that confirm its flagship project, Phoenix, is actually coming online. This is an entirely different level of risk assessment. The recent analyst price target upgrades, while always speculative, reflect this institutional conviction, with a clear majority of analysts maintaining a buy rating and an average target price significantly above the current level. This is not a situation where analysts are simply following the stock price. They are baking in the value of project de-risking that has occurred over the last 12 to 18 months. The tension between expectation and reality here is crucial. The expectation is that Denison is a speculative uranium stock, but the reality is that the $345 million financing event has fundamentally transformed it into a development company with a clear, funded path to production. The next leg up will come not just from rising uranium prices, but from the successful execution of its McClean Lake Joint Venture's planned restart of production in 2025, which will provide a near-term revenue stream and further validate their operational capabilities. This interim revenue, though relatively small in the grand scheme of Wheeler River, acts as a further de-risker and source of operating cash flow, distinguishing Denison from pure exploration stage peers. The focus should not solely be on the Phoenix deposit, but on the integrated nature of the McClean Lake Mill minority stake and the Gryphon conventional underground deposit, which provides a second major long-term production stream. The layered business model. For those engaging in self-investing or using platforms like SoFi Invest or Interactive Brokers trading platform, it is essential to understand exactly what Denison does. Denison Mines is a uranium mining, development, and exploration company focused primarily on the Athabasca Basin region in Saskatchewan, Canada, which is known for hosting the world's highest-grade uranium deposits. Their core asset is the Wheeler River Uranium Project, where they hold an effective 95% interest. This project is bifurcated into the Phoenix deposit, which is slated to use the low-cost ISR method, and the Gryphon deposit, which will use conventional underground mining. ISR is what makes Phoenix such a potential disruptive force, as it significantly lowers operating costs compared to traditional methods by injecting fluid underground to dissolve the uranium and then pumping the solution to the surface, avoiding the high costs and environmental footprint of a conventional mill. Beyond Wheeler River, Denison holds a 22.5% ownership in the McClean Lake Joint Venture, which includes the McClean Lake Mill, one of the world's largest uranium processing facilities. This mill ownership provides a strategic asset, a potential outlet for future production, and a near-term revenue stream as a toll milling service for other producers. In essence, Denison has a hand in all parts of the value chain: exploration, development of a highly competitive new technology, ISR, and processing infrastructure. This layered business model provides optionality that a simple pure-play explorer lacks, which is another area where reality exceeds the simple expectation. Historical context and forward outlook. Historically, the stock's performance has been highly cyclical, reflecting the boom and bust nature of the uranium market. The 5-year return, which is over 700%, demonstrates the explosive potential when the cycle turns up, even for a pre-production company. However, the operational history is less about production revenue and more about strategic asset accumulation and technical de-risking. Earlier financial reports, such as the 2023 figures, often showed net earnings driven not by mining, but by fair value gains on their physical uranium holdings, a strategic move by management to essentially back the company's future with a physical commodity hedge. This move was controversial with some investors, but it has paid off handsomely, giving them significant financial flexibility. Denison's past performance has been characterized by consistent advancement of the Wheeler River Project and strategic capital raises, positioning them for the current cycle. For investors who use investment help tools to screen for quality, the strong cash position and relatively low debt-to-equity ratio, a testament to prudent fiscal management by CEO David Cates, stand out particularly in a capital-intensive industry. The forward outlook for Denison Mines